Okay, so today we're doing chapter 6, variable costing and segment reporting. And I wanted to see if y'all had any questions first about chapter 5. No questions? Okay. And one more thing, I wanted to go over the schedule for the next couple of weeks. So we're going to have our test next week on just these two chapters, chapter 5 and 6. So I'll have the study guide up this weekend for you to start looking at that. Then next week will be the test. So we won't have a lecture. You'll just have to take the test. I'll open it up on Thursday. And after that, we have 3 more chapters, chapter 7, 8, and 10. And we're going to do the lecture the week of Halloween is Monday. So it'll be on that Thursday. And I have chapter 7 on that day. And then the next week I had chapter 8. However, I have an event that I got to go to on the 10th. So I'm not going to do a lecture that night. So we'll do either that week of Halloween will either be chapter 7 and 8, or I may do the week of the 14th, do 8 and 10 together. So we'll have 2 lectures after the test, and one will be on 2 chapters. So I don't know which one yet. I want to look at the chapters and see what I feel will be good to combine together. And then we have Thanksgiving break after we have those 3 chapters. And then the following week will be an exam. And that'll be on 7, 8, and 10. And we'll also have some questions on there from the whole semester. There's only going to be 10. So it's not really a cumulative exam, but there are going to be 10 questions. So we'll go over those as well. So that'll probably be on that last class that we have before the Thanksgiving break. We'll go over those, and then I'll give you examples just so you know what to expect from those 10 questions. And that'll be it. We will not have an exam after that in December, a final exam. So I'll figure out which day I'm doing either 7 and 8 or 8 and 10. And I'll put the revised schedule up once I look at that. So do y'all have any questions about the schedule? Okay. All right, so we're going to go ahead and get started. So tonight we're going to be looking at absorption costing and variable costing. And a couple of things to go over. These are our assumptions for this chapter. We have actual costing rather than the normal costing that we've been doing in the previous chapters with an estimate for those job order costing when we did that predetermined overhead rate. We're not doing that. It's going to be using actual. And then we're going to use the actual number of units produced as the allocation base for the fixed manufacturing overhead. And also the variable manufacturing cost per unit and the total fixed manufacturing cost per period will remain constant. And we'll go through some examples to see, what we're talking about with that. All right, so variable costing. So remember, we have direct materials, direct labor, and manufacturing overhead. So that hasn't changed. Those are the 3 things that we're looking at. We have our selling and administrative expenses, and those fall as period costs. So if we look at the variable costing system, it's telling you what's going to follow the product is that direct materials, direct labor, and variable manufacturing overhead. What we have for period cost is going to be your fixed manufacturing overhead, and then your variable and fixed selling expenses, selling and admin expenses. So when we look at absorption costing, it's a little bit different because we're going to include the fixed manufacturing overhead and the variable manufacturing overhead as part of the product cost. Direct materials, direct labors is still the same. It goes on to the product cost, but this time we're going to have fixed and the variable cost of the manufacturing overhead that will get added in to the product. And then the only thing for period cost will be selling and admin. So we're going to be looking at those side by side and how we calculate that out per unit, and then what does it look like on an income statement, and walking through an example. So which method will produce the highest values for work in process and finished goods? Okay, so before we answer that, I want you to think about it for a second. So if we have, think about what we've been talking about in the other classes with our direct materials are going into our work in process, and then from work in process, we're going to finished goods. So whatever the cost is in our work in process and our finished goods, that cost is going to be on our balance sheet. And so the question saying, which method will produce highest values for work in process and finished goods inventory? So that's going to be the cost of the product. So when you look at these two methods, variable costing and absorption costing, which one do you think would give that inventory or that work in process a higher cost? Anybody want to take a guess?
The absorption costing?
Yeah. Yes, the absorption costing, because the fixed manufacturing overhead is also getting costed in to the product. So that is going to be sitting on your balance sheet as part of your inventory or part of your work in process, because that's going to get pulled in. So yes, absorption costs will be the correct answer. Okay, so here's an example. So we have Harvey Company produces a single product with the following information. So the number of units that we're producing is 25,000. They're telling us that our variable costs are direct materials, direct labor, and variable manufacturing overhead is $10 per unit. And then we have selling and administrative expenses of $3 per unit. Then we have our fixed costs. Our fixed cost for manufacturing overhead is 150,000. Selling and admin is 100,000. So remember the slide that I just showed you where we had the absorption costing and the variable costing broken out. So remember, on absorption costing, part of that variable manufacturing overhead is going to get brought into the product cost. So we'll have to figure out what that is per unit in order to bring that in. Okay. All right, so here it is side by side. So we have absorption costing, which is the one that brings in part of that fixed manufacturing overhead, and also the variable manufacturing overhead. So we need to look at not only the $10 from direct materials, direct labor, and variable manufacturing overhead, but also that fixed. They gave us the fixed manufacturing overhead as 150,000. So in order to figure out what that is per unit, we're going to look to see how many units are we producing. So we're producing 25,000 units. That gets put into the 150,000 so we can come up with the per unit. So and now I'm going to be tacking on that $6. So my unit product cost is going to be $16. On the variable costing side, because we're not bringing in any of the fixed manufacturing overhead, that goes part of the period cost. Now that's just going to be $10 because we're only bringing in the variable manufacturing costs. Okay. So when we do the calculations, we're going to be using these numbers, the 16 for the absorption cost, and the variable costing is going to be 10. All right. So we know we're producing 25,000 units. Now it's telling us that we are going to sell 20,000 units for $30 each. We don't have any beginning inventory. And now we're going to look to see what does that look like on our income statement. So we're going to look at variable costing first. Okay, so we have sales, 20,000 units at $30. That gives me 600,000 in sales. less variable expenses. So we're doing our contribution margin, which you've learned, which is just sales less the variable expenses equals contribution margin. And then we do minus the fixed expenses gives us our net operating income. So this is that contribution format. All right, so we have variable cost of goods, which was $10. Remember, that's direct materials, direct labor, and the variable manufacturing overhead that was given to us on that previous slide. So that's $10 a piece. So if we have 20,000 units that we sold, well, now the cost of goods sold is going to be the cost, right? That's going to follow that sale, 20,000 units. You don't calculate it on the amount that's been produced. You want to make sure you calculate it on what has been sold. So it's our cost of goods sold. So we have 20,000 units times $10 to get 200,000. And then we have our variable selling administrative expenses. Now that was given to us, which I don't think, I have the example printed, but I don't know if you can see that's on my screen when I'm doing the slide. Can you see that on my screen or no? All you see is the slide?
Yes.
Okay, so let me put it to the side and I'll read it to you. So basically, the example said that it's $10 for the variable manufacturing overhead with the direct materials, direct labor, and the selling administrative cost is $3. And so we're going to bring that in. Variable selling and administrative expenses is going to be 20,000 units because that's what we sold times 3 to get 60,000. So our total variable expense is 260,000. That's contribution margin of 340,000. So all we're doing is taking the 600 and deducting the 260. Okay, that's part of our expense. So now the contribution margin is 340,000. So remember, we want that contribution margin to be more than the fixed expenses so that we can have some operating income. If it's less, then we're gonna not have any income. We're gonna be having a loss. All right, so we're going to deduct our fixed expenses, which they tell us the total fixed manufacturing overhead was 150,000 and the selling and administrative expenses was 100,000. Those are both fixed costs. So in this format, you're going to use both of those. So the two added together is 250,000 for a total fixed cost. So now we're going to take our contribution margin less our fixed costs to come up with our net operating income of 90,000. So that's what it looks like if we prepare under the variable costing method. Okay, so now we're going to look at absorption costing. So absorption costing, we have the same sales, 20,000 units, so it's 600,000. Cost of goods sold. Now, instead of 10, remember we have to bring in that additional $6 per unit. So it's 20,000 times 16. So it gives me a total cost of goods as 320,000. So now I have a gross margin of 280,000. Then we're going to do less our selling and administrative expenses. So we have variable at $3 per unit. So it's 20,000 units sold times 3. That gives me 60,000. And then our example gave us a fixed selling and admin expense of 100,000. So we're going to add that back in. So remember, there was 2 fixed costs that they gave us. It was the selling and admin, and it was the manufacturing overhead. So when you're doing the absorption costing, you're not going to bring in the fixed for the manufacturing overhead. Remember, we broke that out for the number of produced, the number of product that was being produced. And we got that $6 because the manufacturing overhead was 150. So we don't bring it in down here as a whole. We're only going to bring in the cost for the amount of units that we sold. So that's why that first question that we asked about what was in inventory, would it be higher? Which method, the absorption costing would be, higher, because some of that is going to be tacked onto that product that's left behind. So instead of expensing that whole thing here as a period expense, only part of it is getting costed out with the product. So we're going to have some ending inventory, and it shows you that down here. So we have fixed manufacturing overhead inventory, which was 5,000 units because we produced 25,000. We only sold 20,000. So now we have 5,000 units left over at that $6. So we have 30,000 sitting in inventory. Okay, so just remember when you do an absorption cost and which cost you need to pull in so that you can calculate this out correctly. All right, so then we have our fixed of 100, our variable of 60,000 for a total of 160,000. We deduct that from the gross margin. So now our net operating income is 120,000. So we have a little more in income because we didn't expense all of that fixed. Some of it's sitting in inventory. Okay. All right, so now we're going to reconcile them. So we look at absorption costing. So we had our cost of goods sold, our variable manufacturing expense was 200,000. The fixed manufacturing expense was 120,000 to get that total of 320. So all they did on this screen is they broke out, remember we had 10, I think it was 10 and it was 6. So if you do the 6 times the 20,000, get the 120,000, and then 10 times the 20,000 units, that would be 20,000. All right, then we have our ending inventory. So remember we had 5,000. So we get the 5,000 units times 10 and the 5,000 units times, I think it was, how much was it? It was 6, I think. So you get the 30,000. So now we have a total of 80,000. Okay, and then you add them up from what was cost of goods sold, 20,000 units, and then that 5,000 that was left over in ending inventory. When you add it up, you get a total of 250, the fixed manufacturing expense of 150, and the 400,000. So this 150 is the total that was given to us of what the fixed and manufacturing overhead was. If you look at the first slide, when we started the example, it tells us variable cost and it tells us the fixed cost. So the fixed cost of manufacturing was 150,000. So when you do the variable costing, you're pulling it in as a period cost, and you can see that down here. When you're doing it as an absorption cost, and you're pushing it over into cost of goods per unit that was sold, and then you're pushing it into inventory for the amount of product that's left in inventory. And then you're dividing it up depending on how much you sold and what you have in ending inventory. All right, so under variable costing, we had the $10 that was given to us as our direct material, direct labor, and variable manufacturing overhead. That was $10. So we have 20,000 units times 10 and 5,000 units times 10. So in the end, we end with a total of 250,000, 150,000 in fixed for a total cost of 400,000. So we can see that we're reconciling where they both end up with the 400,000. But what's different is the cost of that fixed manufacturing. Where is it at? Is it part of your cost of goods sold, or is it part of that period expense in variable costing? So here, the whole 150 is going to get costed out, to deduct from net income. And over here, only 120,000 is going to get deducted from the from your contribution margin to get a net income. Okay, so you have a little bit of a difference there. And we're going to look at that in just a minute. All right, so we have variable costing, net operating income of 90,000. So remember when we looked at that one first, we had 90,000. Well, when we looked at our absorption costing, the net operating income was 120 because part of it was sitting in inventory. Not all of it was with the product. So if we want to reconcile that back, that difference. So what's sitting in ending inventory, that 5,000 units times 6, 30,000. That should be your difference. So if you add the 90 and the 30, you get the 120. It should reconcile back. They're showing you how they got the 6. So remember, this is kind of what the calculation was on that first screen when they had given us the example. It showed that our manufacturing overhead was 150,000 for fixed, and they told us that they were going to produce 25,000 units. So when you take the 150 divide 25, you get the 6 per unit. So that's where that $6 came from that we've been using. All right, so now we're going to look at year 2. So that was year 1. We didn't have any beginning inventory. They told us we produced units of 25,000 units. We have that again on this year 2. We're producing the same amount of units. So the numbers aren't going to change. We already know what our fixed costs are, and we know what it is per unit based on us producing 25,000 units. So that's not going to change. What does change though is the number of units sold. So this time we sold 30,000 units instead of 20,000 units. So that number changed. And then we have a beginning inventory this time of 5,000, where the first year we didn't have any beginning inventory. Our unit sales is the same. Okay, so then it's just giving you all the information that was given before for the first year. Nothing's changed. We have that $10 for direct materials, direct labor, and variable manufacturing overhead. We have variable selling and administrative expenses of 3. The fix is the same, 150, and then the fixed selling and administrative expense of 100,000. That's the same as well. All right, so here's our chart again. So remember, we're still producing the same number of units. So this $6 stays the same because cost is the same, number of units produced is the same. All right. So when we look at variable costing, now our sales is a little bit different because we have 30,000 units sold at $30. So it's a total of 900,000 in sales. Then we have variable cost of goods. Now remember, that's the $10 that's given to us times the 30,000 units sold, so it's 300,000. Variable and selling administrative expense is $3 per unit, so it's 90. So a total variable expense, 390,000. So we take our sales less our variable expenses to get our contribution margin, which is 510,000. Then we deduct our fixed costs. So we have fixed manufacturing overhead of 150,000. We have fixed selling and administrative expense of 100,000 for a total 250. And now our net operating income is 260,000. Let's look at it for absorption costs. So same for sales. Now we cost of goods sold, we're using that $16 because we're pulling in part of that fixed manufacturing overhead, which is $6 per unit. So now we have 16 times 30,000 to get the 480,000. Our gross margin, we're just deducting the 480 from the 900 gives us 420,000. And then we have our selling and administrative expenses. So the variable selling and administrative expense is $3. So it's 30,000 times 3, which is 90,000. They gave us a fix of 100,000 to get a total of 190,000. We deduct that from the 420. So our net operating income is 230,000. So now it says that we have our overhead, manufacturing overhead that's now released from the inventory. Because remember, we only produced 25,000, but we sold 30,000. So we're selling 5,000 that was produced from the year before. So that was sitting in inventory. Well, now where does it move? It moves into the cost of goods on the absorption costing method. So now we have that 5,000 units times 6, which was the 30,000. That was an ending inventory from year 1. That moved into the cost of goods sold. All right, so with variable costing, we had a net operating income of 260, which was higher than the absorption costing of 230. And we need to deduct out that inventory, that 5,000 with the $6 per unit at 30,000. So remember, the variable costing has a net income of 260,000 because the entire manufacturing overhead was expensed in the previous year. So you have that, you have to deduct that in order to reconcile back to your absorption costing of 230,000 in profit. Okay, so over the course of the 2 years, everything's going to work out the same. And I think we have a slide next that's going to look at that. But you can see that depending on the method you use will determine what that net operating income is, where that fixed expense is sitting at the end of the year as well. And this is just giving us our calculation of the fixed manufacturing overhead again at that $6, how they came up with it. All right, so here's the two methods and the 2 years that we just calculated. So for absorption costing, we had 120,000. Variable was 90,000. So variable was lower because we produced more than we actually sold, and we had to deduct the entire fixed expense. For the second period, we produced less than what we sold. So we have 230,000. It's more, I mean, it's less than the variable of 260 because now we have some of that cost from the previous year that was sitting in ending inventory that's now part of the product that we sold. So it's going to be less. The variable is more because now it's just, that fixed expense is coming out and we had more units that we sold. So it's higher than it was previous year. All right, but in the end of the 2 years, if you look to see what your net income was, it's 350,000 for both methods. Okay. All right, so this chart could be helpful when you're trying to figure out what's happening. So we have the units that are produced and we have the units that are sold. So if they equal, like the amount of units we produce is the same that we sell, then we don't have a change in inventory because we've sold everything. And our methods will be the same because it doesn't matter how we cost it out. The whole thing's getting costed out because the same number that we produce is the same number we sold. So everything will equal there and you won't have any ending inventory. Now, if you produce more than what you sold, your inventory is going to increase. Why is that? Because we produced more than we sold and some of it is still in our inventory that we need to sell. So the inventory is going to increase. And that means that our absorption costing is going to show more than the variable costing method. If we do units produced as less than what was sold, so we're producing less than what we sell, our inventory goes down. So think about the example. We produced 25,000, but we actually sold 30. So we're pulling from our inventory in order to fill those orders that we sold. So our inventory is going down. So inventory is decreasing. And in that method, we're going to have absorption income is going to be less than the variable income. Okay, so you might want to just look at the example and try to follow with numbers. It might help you understand it a little better. Okay, so variable costing categorizes cost as variable and fixed. So it's much easier to use this income statement format for the CPP analysis, which is what we're looking at. And then the absorption costing assigns fixed manufacturing overhead to the units. So think about the example that we had that was at $6. It took the fixed and divided it by the number of units produced. And a portion of that fixed manufacturing overhead will stay in inventory as unsold. And then the potential result is positive operating income because some of that fixed cost isn't going to be brought in as a cost, right, for those units that were sold. And it says that when the number of units are sold is less than the break-even point. Okay, so we're going to have a positive income when the number of units sold is less than the break-even point. All right, so now we have variable costing income is only affected by changes in unit sales. And it's not affected by the number of units produced because we're not worried about what that fixed is and trying to divide it by how many units are we producing and putting that into the cost of those units. It's just going to come out. So our variable costing, that unit cost is going to stay the same, right? It doesn't matter about what's produced. And then as a general rule, you can remember that when the sales go up, net operating income usually will go up as well. And then vice versa. When the sales go down, the operating income is going to go down. Now with absorption costing, we're taking a piece of that fixed cost and we're putting it with the product. Okay, so the income is influenced by changes in the unit sales and the units of production because it depends on what we're producing for that year and what we've actually sold. So when we just looked at that chart, you can see that if you produce, more or less, that's going to affect the income. So that's all they basically say in here is that same thing we just looked at on the chart. So the net operating income can be increased simply by producing more units, even if those units are not sold. Okay, that's because it will sit in inventory. All right, it won't go onto that income statement. Variable costing correctly identifies the additional variable cost incurred to make one unit. So $10 per unit for the Harvey Company was the example that we looked at. And it also emphasizes the impact of total fixed costs on the profits, because it's taken the entire fixed cost out at the time. So it doesn't matter what was produced, and it's not getting brought into the product. So it's just, you're deducting those fixed costs, right? So remember that formula that we learned for the contribution margin. It's the sales minus the variable expenses. That gives you contribution margin, and then we deduct in the entire fixed. All right, and then because of the absorption costing, assigning fixed manufacturing costs per unit. So remember 6, that was our example. We had 150,000, and then we divided by what was produced at 25,000 to get the 6 per unit. It gives the impression that the fixed manufacturing overhead is variable with respect to the number of units produced, but it's not. So we're taking that total and dividing it by the production of units. And they're basically saying, okay, this looks like it's a variable cost because we're putting it into the product, when it's really not. It's a fixed cost. But it says the result can be inappropriate pricing decisions and product discontinuation decisions. So you might make decisions based on the numbers that you're looking at, and it's not exact, because you have some of that, that fixed cost that's added into the product, and that could be sitting in inventory. All right, so now we're going to look at segments and segmented income statements. So what is a segment? A segment is any part or activity of an organization about which a manager seeks cost, revenue, or profit. So one company can have different segments. So think about, and this will be one of the examples they use, think about Coca-Cola products or Pepsi. They produce different drinks. And so each one of those might be a different segment. And they can look at that segment and say, okay, well, this product that we're producing isn't making any money, so we're going to eliminate that segment. Or maybe you can look at it and say, okay, well, this one's doing really good, we're going to produce more of this product. So depending on what's happening with that particular product or that segment of the organization, you may want to do more there or do less there, or get rid of the product altogether. So they're saying you can have an individual store, and inside the store you can have a service center, you can have a sales territory. So when I worked at a car dealership, you have all these different departments within there, so they're treated like different segments. So you have the entire organization, but what is happening at a car dealership? You have new car sales, you have used car sales, you have a parts department that sells parts. You also have a service department where you have cars coming in and you're servicing them with labor and parts. So there's different segments within that organization. And so you may look at all those different segments and, say, okay, well, I do need my parts department because I need to provide parts for my service department, and I'm selling new and used, but it looks like I'm making more money on used and I'm losing out on these new cars. Maybe you're going to restructure your organization. You're not going to sell new cars anymore. So it helps you break things down and kind of look at what it is, and you can trace some of those costs to those segments. So there's 2 keys to building segmented incomes. So we have a contribution margin format. It should be used because it separates the fixed from the variable costs. So remember, the contribution format is the sales less the variable expense gives you your contribution margin less your fixed expense to get net operating income. And then we have traceable fixed costs that should be separated from common fixed costs to enable the calculation of a segment. So basically, you will have certain costs that you can trace to the segment. And then you're going to have other costs that are just common costs. You can't really say they're going to go away if you get rid of one of the segments. So those are called common, and you're going to have them either way. So you have to identify those too when you're doing segmented. All right, traceable fixed costs arise because of the existence of a particular segment and would disappear over time if the segment itself disappeared. So if I have, one of the examples I give is a product manager for a particular product that PepsiCo is producing. They produce in Fritos, and that manager All he does is oversee the production of that particular product. So if they decided not to produce Fritos anymore, that manager goes away, which means that fixed cost goes away. They also give another example of a Boeing 747. So the maintenance cost for the building, which the Boeing 747s are assembled, is traceable to the 747 business. So if they wanted to get rid of the 747 business, well, they may be able to get rid of that building and where they are maintaining the Boeing 747. So it's something that you can trace over to the product that's being produced. All right, the common fixed costs arise because the overall operation of the company and would not disappear if you had the particular segment eliminated. So here's an example of that, a salary of the CEO. So remember, we were looking at the salary of the product manager. So he will only oversee that product. If that product goes away, he goes away. But the CEO of the whole organization isn't going to go away because you got rid of one segment. He's still there. So that's a common fixed cost. That's not going to go away if you get rid of a segment. And then the cost of heating a Safeway or Kroger grocery store is a common cost of the various departments. So maybe you have different departments within the grocery store, but it doesn't matter if you stop selling one type of product, you're still going to have to heat the whole store. So as long as you have that building, you're heating that whole building, regardless if you get rid of one of the product lines or not. All right, so it's important to realize that the traceable fixed costs of one segment may be common costs of another segment. So for example, they talk about the airline. So the landing fee that the airlines pay to the airport is traceable to the flights, but they can't necessarily trace that to first class, business class, or economy class. So you have different types of passengers on that plane. The fee is just a regular fee for any plane landing. It doesn't take into account what type of classes you have on your plane. You're still going to have to pay it. All right, and then the segment margin, which is computed by subtracting the traceable fixed cost of a segment from its contribution margin, is the best gauge of the long run profitability of a segment. And we're going to look at an example of that so that you can see what that means. All right, so we have fixed costs. And this is just saying some of those fixed costs can be traceable to that segment and some are common because we can't trace them to a particular segment. We're going to have them regardless. So this common right here, you would not allocate that to the segment. You're only looking for traceable, and most of the examples you're going to have is going to give that to you. All right, so we have Weber Inc. They have two divisions, computer and television. And we're going to look at the television's income statement. All right, so we have the television division, and we want to know, like, how much is that division making as a whole? So we have sales of $300,000, variable cost of goods of $120,000, other variable expenses is $30,000. So we have a total variable expense of $150,000. So we deduct that from the $300,000. That gives us our contribution margin of $150,000. The traceable fixed expenses are $90,000. So we deduct that from the contribution margin to get what was that division's margin? It's $60,000. So this is what we're making on the television division. Okay. So sales minus the variable expense gives you your contribution margin less your fixed. It's going to give you that income for that segment. All right, so now let's look at the contribution margin. Well, it's just basically saying the same thing. We're not going to go over that slide. It's telling you basically the same thing I just said. Okay, so the income statement shows that the company's bringing in sales of $500,000. So remember, we just looked at this, the television segment. They're showing us the computer segment as well. So when you look at the company as a whole, you would just add these segments up to get the whole sales, the whole variable expense. Okay, and then as you bring it down, it shows that we have traceable fixed costs of $90,000 for television and $80,000 for computer. So our total traceable fixed cost is $170,000. and the division margin's 100. So that's just showing television 60, computers 40. Now we may have some additional common fixed costs that have to come out to come up with our net income. So let's see on the next slide. Okay, so we have 25,000 in common expenses. So this is just additional expenses that we could not trace to one of the segments. So you want to make sure that you don't bring that into those other two segments unless it asks to allocate that, and we'll look at an example of that in a minute. Okay, but for now, those expenses are separate and they don't get added to the division, but they have to come off what that margin is in order to come up with the net operating income. You have to deduct those. All right, fixed expenses that are traceable to one segment can become common expenses if the company is divided into smaller segments. All right, so let's look at an example like that. So in the television division, we have two product lines. We have regular TVs and we have big screen TVs, which maybe y'all gonna be watching a big screen later to watch the Saints game. I think it's tonight. All right, so here is our information on our regular and our big screen. So this is how we're selling. We have, 200,000 in sales for regular TVs and we have 100,000 in big screen TVs. Variable costs are 95,000 and 55,000. So we have a contribution margin of 105 and 45. Traceable is 45 and 35. So remember, what it was telling us our expense was, our traceable was 80,000 for that television division. So here's 80,000. And then we have an additional, you're gonna have additional monies because remember the example that they gave us when we looked at the television division, it told us that the fixed cost for television was 90,000 and they're only coming up with 80,000 here. So we have some common expenses for this division. All right, so here we go, 80,000 for fixed, traceable, and then 10,000 for common expense. So our division is 60,000. So we were given this piece earlier. Now it's broken out a little bit further. And it's just showing you that when you look at it here, we know that we have, 90,000 in total fixed costs. But when you break it out even further, sometimes you can't trace that to those products. So within that division, we now have common fixed costs. So we have that 90,000 right there, the 80 and the 10. All right, once the company prepares the contribution format segmented income statement, it can use the statement obviously to make decisions and perform break-even analysis. All right, so we're looking at television department. We are increasing our sales by 5%. It tells us that we have additional advertising of 5,000. So that's now going to get costed into the common expenses. And maybe that's because the 5,000, when you are advertising, you're advertising both regular and big screen TVs. It wasn't some type of advertisement for just big screen TVs. So you can't really pinpoint, which one it was. It's for the whole selling of TVs, regardless of what kind they are. So it gets added into the common. So now it tells you what happens. So if I increase the sales by 5% because I spent 5,000 on advertising, now what does that look like? So we have a margin increase of 5,250, and then we have a margin increase on the big screen for 2,250, and the margin overall will increase by 2,500. Okay. Now the reason why you can't just add these two up is because we spent additional money. Right, so we had to take that 5,000 out. So if you take these two, I would imagine if you add these two together, it'd be 7,500. You take your 5,000 out of it, that gives you 2,500. All right, so let's look at segment break-even points. All right, so here's our income statement, which is what we just looked at a minute ago. We have our whole company. It's got that additional 25,000 that can't be traced to television or computer for the net income of 75,000. So now we want to calculate the company-wide break-even point. All right, so how do we calculate the break-even point? So we're going to add well, we're going to add the company-wide break-even point by computing and dividing the sum of the company's traceable fixed expenses and common fixed expenses by the company's overall contribution margin. All right, so for our contribution margin, we have a contribution margin of 270,000. Let me see if I can go back. And show you the numbers. So you know where it's coming from. All right, so right here, we're looking at the company, 270,000, okay? We're dividing that by the sales of 500,000 to come up with our contribution margin ratio, which is here 0.54. So you see it's the contribution margin 270 divided by the sales of 500, and we get that 0.54, okay? And then we have our fixed. So remember, we have the fixed that's traceable, but we have to add the common fixed as well. So it's just fixed cost over the contribution margin ratio to come up with our break-even point, which is 361,111. So this is the same exact formula that we used in the previous chapter. Okay. All right, so now we're looking at the segments. So we have our break even of 90,000 over the 0.5. They're showing us where does that contribution margin ratio come from? Well, we had a contribution margin ratio for television of 150,000. 150,000 over, here it is right here. So here's my contribution margin, 150,000 divided by the sales. And then on the computer, we should see 120. And that should be divided by 200. So that's where the numbers are coming from. So here it is here. So we have a contribution margin ratio of 0.5 for the television. And then for the ratio on computers, we have 0.60. So you have to calculate that out first. All right, and then we take in, let me go back. So the 90,000. Okay, so here's our traceable fixed cost. We have 90,000. We have 80,000. Okay. So we take in 90,000 divided by the contribution margin ratio to come up with 180,000. So we're just looking at the fixed cost for that division. We're not looking at the common fixed cost. So remember, when you're looking at the segment, you don't want to bring in the common, right? Because it's not being allocated out to those two within that division, that television and computer. It's not getting added in there. If you want to calculate what the television's break-even point is, or what the computer's break-even point is, you don't want to bring in the common. If you're looking for the company's break-even, you will. So we did that one first, and now this one we're looking at the segment. So just keep that in mind. If you're looking at the segment, you don't want to bring in the common. All right, so with 90,000 divided by the 0.5 to come up with 180,000, and then the 80,000 over the 0.60 gives us 133,000. So that's our break even. All right, so it's basically just saying on here that we have this 25,000 in common expenses. They're excluded from that segment when you're trying to calculate out the break even sales, and then if you can't trace those to the segments, then they shouldn't influence the decision. So that's why it's not brought in. All right, so we have costs that are assigned to a segment. They should include all costs attributable to that segment from the company's entire value chain. And I'm sure you've seen the value chain before in probably your marketing class or your business class. So you have value chain, you have research and development, product design, manufacturing, marketing, distribution, and customer service. So all of that, would be considered when you're looking at the segment. All right, so failure to trace those costs directly. So the costs can be traced directly to specific segments of a company and should not be allocated to other segments. And then it says some companies allocate costs to segments using an arbitrary basis. Those costs should be allocated to the segments only when the allocation base actually drives the costs being allocated. So basically just saying they can take those common, they can allocate them to the segments if they can trace them. Common costs should not arbitrarily allocate to the segments based on the rationale that someone has to cover the cost. Well, you don't want to do that because then you really can't see what's happening in that segment. So the practice of doing that may make a profitable business seem like it's unprofitable. So if you're adding in additional costs that maybe isn't for that segment, you just allocate it there. Maybe your allocation's wrong and you allocate it too much, it could look like it's not profitable. And then allocating those common fixed cost forces the managers to be held accountable for costs that they can't control. So the managers are going to be held accountable for the costs, those fixed costs, and those ones that are coming in they can't control because it's not something that is traceable to them or not something for that segment. It's just getting costed in and the allocation's all wrong. Well, then they could be accountable for that. All right, so we're going to look at an example real quick. Let's see. So we have Hoagland's Lakeshore. We have a bar and we have a restaurant. Okay, so in our bar, this is our numbers for our bar. And then this is the numbers for the restaurant. We have additional common fixed costs of 200,000. So our total net operating profit is 44,000 for Hoagland. And it says how much of the common fixed expense of 200,000 can be avoided by eliminating the bar. So we want to eliminate the bar. Where's my mouse? Go back. All right, so they're saying how much can I eliminate of this 200,000 in common expense if I get rid of the bar? So what do you think? Do you think that none of it, some of it, all of it, what can be avoided? Remember, it's common. Somebody guess.
None.
Right, none. So we can't get rid of any of those costs because they're not traceable to that segment. So they're not going to go away if you get rid of that. All right, suppose the square feet is used as a basis for allocating the common fixed expense of 200,000. So how much would be allocated to the bar if the bar occupies 1,000 square feet and the restaurant is 9,000 square feet? So we have a total of 10,000 square feet, right? Hang on, let me get to draw. So we have a total of 10,000 square feet. Now, the bar is 1,000 of that, or 1/10 of that. So how do we calculate out how much of the expense is going to go? Well, we just take that and times it by the 200,000. So what is the 10% of 200,000? It'll be the 20,000 or 1/10. There it is. Okay. All right, so the bar would be allocated 1/10 of the cost or 20,000. So if Hoagland's allocates its common expense to the bar and to the restaurant, what would be the reported profit of each segment? So they're allocating the common fixed costs expenses to the bar and to the restaurant. So they're going to take that 200 and they're going to break it out. So we're going to go based on the square footage in the example that they just gave us. So we already know that we had 200,000 in fixed costs and 10% of it went to the bar. So the other 90% is going to go to the other 90% is going to go to the restaurant. All right, so this is what it's going to look like. So here's the bar. So now it was profitable of 14,000 because we had a segment margin of 14. Now I'm getting 20,000 allocated to it. So maybe using the square footage isn't a great way to allocate those common expenses, but I'm doing that. And what happens? It looks like the bar is losing money. right? So maybe that's not a good way to allocate those common expenses because of square footage, you know? So you maybe would make a bad decision to close it because you are making a little bit of profit here. So your net operating profit was 44,000. So if we eliminate the bar, what happens? Do you think you should eliminate it? Yes or no?
No.
No, because we would lose out. We'd lose out on the 14,000. So we had a profit of 44,000. So we lose out on that 14,000. What happened? Now our profit's going to drop to 30,000. Maybe more, because how much business, you know, is people going into the bar and then having food because they're in the rush, you know, they're there, you know, maybe they're eating because they went to the bar. All right, so a couple of things that I know that y'all are not accounting majors, but this is something that they kind of focus on when you're in the accounting program. They want you to learn your US GAAP, which is the generally accepted accounting principles. I'm sure you heard that from your principles class. And then there's IFRS, which is that international standards that they compare the two because a lot of companies are doing business internationally. And so it's basically telling you that both of those require the absorption costing for external reporting. So since absorption costing is required for external reporting, most companies will use it for internal reporting rather than incurring the additional cost of maintaining the separate variable costing system for internal reporting. So since they have to report it for the absorption costing, if they have to report it that way, they don't really want to do variable costing as well, because then you have to invest in two systems. So the absorption costing, the fixed manufacturing cost must be assigned to the products. So remember, that was the example we looked at. You take that fixed manufacturing cost, you look to see what products are being, how many units are being produced to come up with that per unit that's going to get added in, and it's assigned to the products. And it says the fixed manufacturing cost must be assigned to the products to properly match revenues and costs. And then for variable costing, the fixed manufacturing costs are capacity costs and will be incurred even if nothing is produced. So remember, we have those fixed costs that are getting subtracted out in the end. So even if we don't produce anything, they're still gonna go on the income statement. The absorption costing, they're gonna stay with the product. And both require publicly traded companies to include segmented financial data in their annual reports. So some companies, they maybe will avoid using the contribution approach, because if they do it internally, then they're going to have to share that information with the public, and sometimes they don't want to do that. And so so maybe they avoid doing the contribution approach. And then the companies must report the segmented results to shareholders using the same methods for the internal. So if they're producing those contribution margin format type income statements, they have to do that for the shareholders as well. So sometimes they don't do that because they don't want to share the information. Do y'all have any questions about the chapter? Or any other questions in general?